Welcome to the Long-Term Care Sampler. Did you know that a 55-year-old couple today has a 50% chance of at least one of them living until age 93? Or that for somebody who's 65 today, there's about a 70% chance they will need some form of long-term care at some point in their lifetime. For us women, we tend to live longer, and when we do need long-term care, often it's for longer periods of time. Now, yes, it's true that maybe 30% of 65-year-olds today will never need any form of long-term care, but on the flip side, about 20% are going to need at least 5 years or longer of long-term care. Do you see the need? Yes, absolutely. Now, you might ask me though, well, if I need long-term care, won't my health insurance just cover that? And the answer sadly is no. Health insurance won't cover long-term care costs. What about Medicare? Well, some, up to 100 days worth of coverage. It will require 3 days of hospital care with treatment, plus some other requirements in order to qualify for that. But what about Medicaid? Yeah, that's true. Medicaid does. However, Medicaid is only available for those who meet certain income requirements, as well as have very limited cash. Like the countable cash that they're allowed to have in order to qualify is only $2,000 to $3,000, depending on whether they're single or married, what state they're in, and a few other qualifications. So the need is real, especially for people right now who are in their 50s and 60s to be thinking about what are my options. Now, generally speaking, there are two main types of long-term care insurance. You have your traditional and you have your hybrid. Both are intended to care for us if we need help in some of the basics, such as eating, transferring, toileting, bathing. And whether or not we need those based, and they're for us if we need those, whether it's based on kind of illness or injury or simply old age. Now let's take a peek at your traditional long-term care life insurance. Your traditional long-term care life insurance is a little bit like car insurance in that it's something you don't actually ever want to use. But if you do need it, boy, are you glad that you have it. What are some of the pros of this type of long-term care coverage? Well, your initial premiums, kind of that cost of entry, is typically going to be lower than your hybrid coverage, which means that it can be affordable to somebody maybe who has good cash flow, right? But not too many assets. And so that lower entry of cost. The second positive are the tax advantages. So often your money going in is going to be tax deductible, and those benefits that come out are generally also tax-free. The third advantage, if you're in a state that is a part of what's called the Medicaid Partnership Program, then all of that money that's going into your long-term care premiums basically is protected. It's like a form of lifetime asset protection, so that if at some point you've used up all of those benefits that you've paid for, you're not going to be required to spend down the amount that you put into the policy in order to qualify for Medicaid and Medicaid to kick in and then take over and help. So that then protects that chunk of assets for yourself as well as for the next generation. What about the cons? The biggest one I can think of is you use it or you lose it. The second one is that the cost of premiums can rise over time. What that can mean is somebody can be paying into it for years, and then they're getting right near that age where they might actually need it. If the premium cost goes up and they can't afford it and they let it go, suddenly now they're vulnerable and they've spent all that money over all of that time. The third one is no cash value. There's no cash value within it, unlike your hybrid policies. Now let's take a look at those hybrid policies. What are they? Typically, your hybrid policies are going to be some form of life insurance with long-term care or an annuity. And what they do on the positive side is you have a guaranteed benefit. So if you don't use it, a portion to more than what you put in, depending on the company and the type of policy, is available to yourself and your heirs, your beneficiaries. So if you don't use it, you don't lose it. It's your money. You need it for long-term care, you use it for long-term care. Otherwise, it can be passed on. Love that. Tax benefits are there as well. Actually, before I look at tax benefits, let's look at growth. Generally speaking, these types of accounts also have some form of growth in them. to where you can have cash that's going to be slowly increasing or growing over time, which then ties into those tax benefits because that growth is going to be tax deferred. You're not paying taxes on that growth every year. Also, another tax benefit, just like with your long-term care kind of traditional type of insurance, is that the benefits paid out are generally going to be tax-free. Another piece here that's important is premium stability. So either a lump sum up at the beginning, or you're going to know exactly what those premiums are going to be every single year. You don't have to worry about whether or not you can afford it because you've already planned and that you know you can, right? The last piece in terms of positive, and we've touched on this, is dual purpose. These can act almost like you've got a piece that's available for long-term care. You don't need it. You have a piece that's a part of your estate plan. What about the cons? What about the downsides of this form of insurance? Well, for one, your upfront cost is going to be higher than your traditional long-term care insurance, which means that maybe it's not affordable for everybody. And then you have an opportunity cost as well, because that cash value portion, that investment portion that's growing, probably would have higher growth potential in other types of accounts. Now, both your traditional and your hybrid, both of them offer peace of mind, comfort, security for you and for your loved ones in your later years of life. And if you're somebody who has, for example, really good cash flow but lower assets, maybe your traditional policy might be the better option. If you're somebody who has significant assets but maybe your cash flow isn't quite as strong, maybe your hybrid type of policy is going to be the best option for you. But either way, you're putting in place peace of mind for yourself and your loved ones.